And now for the table of knowledge. V. All right, so we were trying to find something, but actually I think this is quite an interesting topic. So.
It is an interesting one. So we're doing V for venture capital or venture capitalists, which I think is a term that everyone's kind of heard but just go, I have no idea what the hell that is.
And that's what we're all about here at the Table of Knowledge, is to explain what these things are. I must admit, I do know what venture capital is. I'm not suggesting I didn't, but I did learn some stuff by reading about it. So
always learning.
Always learning, and that was why it was a good topic. So let's start with what is venture capital?
So a venture capitalist is essentially a private equity investor that provides capital to companies with high growth potential in exchange for a stake in the equity of that company.
That's right. Now, it's typically at startup phase. So you have got private equity and you have venture capital. Now, it is kind of the same thing, but venture capital tends to be more for those early innovation companies where, they're sort of at that startup phase or they need money to launch their product or launch their idea or whatever they're doing. So it is private equity tends to be more of a long-term investment, whereas venture capital tends to be a little bit shorter term and a little bit earlier on in the piece.
It also is a bit riskier. So there is
very risky. There
is the rate of failure is quite high, but when the reward does pay off, it's a big reward.
That's exactly right. Now, the other thing with venture capital and venture capitalists and venture capital firms, which is typically, usually venture capital comes, you go to these days, you go to a venture capital firm and you pitch to get some funding. They like to be very involved in what you're doing. So private equity may not be so involved, but venture capital money will want involvement. They'll want to have a pretty good say in what you're doing. They want to be a mentor to you. They want to provide you technical expertise and management expertise as well.
That's right.
So it's a good partnership to have, but it may not always result in what you're wanting either. So you've got to be very careful. If this is the path you want to go down, you've got to expect that the venture capitalist is not going to want to be there for 20 years. They're going to want a fairly quick turnaround and to see that they can, you either sell the firm, you either merge with someone else or potentially go to what's called an IPO, which is like when you essentially list on the stock exchange and your shares are converted to normal, stock exchange traded shares, and they can essentially sell out that way.
That's right. So you do lose a lot of control over the business as well. So it's not that you just get the cash and you get to kind of do whatever you want.
So do you want to talk a little bit about the history, where it sort of started?
Yes, I will.
I know you've done a bit of research on that.
I have. So I did learn where it started. So the first venture capital firms, it started in the US and it started in the middle of the 20th century. So George's Doriot? I don't know. Doriot, yeah.
That sounds like a good way.
We'll go with that. So he was a Frenchman who moved to the US to get a business degree. He became an instructor at Harvard Business School and worked at an investment bank. So pretty cluey man. And in 1946, he became president of the American Research and Development Corporation, which was the first publicly funded venture capital firm.
Yeah, he's known as the father of venture capital. They raised $3.8 million to invest in companies that were commercialising some of the technology that came out of World War II. And for an example, they had a X-ray, there was a company that was developing X-ray technology for cancer treatment. They put $200,000 into that and sold out in 1955 for $1.8 million. So that was a nice little tidy return on that profit.
Absolutely.
Particularly back in those days.
Yeah, that's right. It's a lot of money back then.
Yeah. So typically venture capital has different levels, and if you hear people talking, often, I don't know if I listen to lots of podcasts. I lost a lot of people who were on some of those podcasts like The Diary of the CEO or Girl Boss and all that sort of stuff. They often talk about their capital raising and there's different levels. So first of all, if you are looking at doing some venture. The first starting point usually is what we call family and friend round, which is where you basically go and ask your family and friends for money, okay? You're really bootstrapping this idea. It might be your own savings or whatever, and then you get to a point where you're thinking, I might need a little bit more help. So the very first instance is what's called seed or pre-seed, which is before you even sort of get to a point of launching products, kind of like business planning development. Often if you're doing that sort of thing, you might be involved in either an accelerator or incubator program. These are often at universities or in Canberra there's an innovation hub down there where you can sort of get involved there and they can help you to find some funding to get your project up and running. So that's the pre-seed. The next one is called seed funding, which is actually the money to start the business up and to get that first product out to market. And then once you've gone past that, then you have the early stage funding, which is then to take it a little bit bigger, and often that's a Series A or a Series B capital funding. So you can, if you hear those terms being sort of said in these podcasts or interviews, you might know what they're talking about now.
And now you know what venture capital even is.
Yeah. Now, why do people do this though? Why do people invest?
Well, because they get an equity stake. So essentially when that company or that business products, it grows and it merges or gets sold, whatever happens, they get that stake back as well.
Yeah. So, like we said, it's very high risk, but it also can be very high reward. But the other thing that does incentivise people to invest in this is that there are tax incentives. Now, both in the US and in Australia, we have certain tax incentives. Now, I'm not going to suggest that anyone who's listening to this go, I'm going to grab some of these tax incentives. They're pretty difficult to get. But that is why people do invest in venture capital, or one of the reasons. So I might talk about this because I think this might be okay.
That's right up your alley.
So in Australia, we have got various different types of venture capital tax incentives and sort of different structures, I guess. There's what's called a early stage venture capital limited partnership. There's a venture capital partnership. There's the Australian Venture Capital Fund of Funds. But the one that probably a lot of people, well, not a lot of people, but maybe more accessible to everyone. So to get into those, you'd actually have to invest in a venture capital firm who would then take advantage of those things. But from a normal investor type of thing, there is what's called the early stage innovation company, which is, and if you are investing into what's known as an early stage innovation company, you can get some pretty good tax incentives. Now, what those incentives are, the first one is that you can get we can get a 20% tax offset for your investment, up to a cap of $200,000. Now, that's quite a significant tax offset. It's a non-refundable tax offset, so you can only use it against tax payable, but it can carry forward as well.
Yeah, it's a pretty big amount.
Yeah. And the other really big incentive is that any capital gains that are made from that investment, if they're held for, sorry, we've got birds flying past. If they're held for more than 1 year but less than 10 years, they can actually be disregarded.
Oh, that's a big one.
That is a very big one. Now, to get that, there's a whole lot of criteria around it. So first of all, you have to be investing in what is called an early stage investment company. To do that, you have to pass a number of tests. So the first test is what's called the early stage test, which essentially means that you have to be a company and you have to be registered on the Australian Business Registry. You have to have total expenses of less than $1 million in the previous year, and total income of less than $200,000 in the previous year. And you mustn't be quoted on any stock exchange either here or anywhere in the world. So that's probably not super hard to pass. But the second part, you have to pass one of these tests. So one of them is called the 100-point innovation test. And the other one's called the principle-based innovation test. Now, the 100-point innovation test, if you're really interested, go and Google it on the ATO website. It does tell you what makes up that innovation test. It doesn't mean I'm thinking of starting a business and I'm being innovative in it. It's like all around research and development, patents, grants for you really do need to be doing something kind of unique and new and developing. A lot of it is around that research and development stage of stuff. And then if you feel like that, and that's the one they usually recommend people to try and pass because it's pretty obvious. If you don't feel like you can do that, then the principle-based innovation test has information around it as well, but typically you would go to the ATO and get a private ruling to agree that you've passed that test. Now, if you're investing in this stuff, okay, there are caps on that $200,000 thing if you're not considered to be a sophisticated investor. So there's a whole lot of stuff around it. If it's something that's interests you, you really need to read it. So there are caps on that. It's actually your responsibility to make sure that the people that you're investing in are considered to be an early stage investment company.
Oh, okay.
So you need to do the homework to make sure that, like, when you're putting this into your tax return, that you are doing it on something that is actually correct. It's not necessarily their responsibility, it's your responsibility. And so that's pretty much it. But there is a lot of regulation obviously around it. You don't get tax incentives like that just for investing in a company that mum and dad are starting
No,
up.
absolutely not.
Yeah, so anyway, that's a bit of an interesting one. Couple of other facts while we're at it.
Go for it.
I don't know what else if you've got anything. In Australia, we have on the business.gov, if you are wanting to find out more information, the business.gov.au has some really good information on there. They have a dashboard that tells us what sort of funding we've had in the essentially. So here's some stats for you. On the 2021-2022 dashboard, there's been a lifetime program commitment of capital of $28.23 billion in Australia to the innovation, like venture capital stuff. 2,351 businesses have been assisted, and foreign capital actually makes up more than 50% of that. Just going back to those early stage investor stuff, that doesn't necessarily only apply for Australian companies, it can be for foreign investors as well. Okay.
Interesting.
And I guess have you got anything to add?
I just wanted to add that just keep in mind that a lot of our big companies like Facebook and Twitter, they started with investments from venture capitalists as well.
Yeah,
so,
I mean, Silicon Valley is where it all...
Yeah, there's so many of our big companies that started from venture capitalists, and I just think that's kind of interesting to know the history of them as well, because you think of Facebook and it's huge, and it started with venture capitalism.
So that... Good segue. I was going to talk about one of the biggest venture capital firms in Australia, which is called Blackbird Ventures. It started in 2012. It started with 3 people. They now have 12 people working for them. And they manage 3 early stage venture capital limited partnership funds. So this is not the investment company. It's actually like there's a partnership. So then they invest in different entities. So they've got about $194 million that they've invested in over 90 companies in both here and overseas, but I imagine mainly in Australia. They have about 110 investors, so people can come to them and invest, but most of the people who invest tend to be super funds or, some of those larger things. But there, of course, are individuals who can invest there too. Probably their most famous story, which I know you will know, is Canva.
Yes. I do know that.
So they invested in Canva back in 2012 in the seed funding, in their very seed round, so just before they were about to launch. They put $250,000 into that. They have now put in up to $50 million into Canva. Wow. And Canva is what's known as a unicorn. Do you know what a unicorn is?
No, I don't.
Okay.
You go for it.
So in the venture capital world, a unicorn is a firm that's valued at more than $1 billion.
Wow.
Now, I'm not sure if Canva is still classified as a unicorn, but they certainly did hit unicorn status.
I think they're still pretty high up there.
Yeah,
I do.
I know their share price did drop off a little bit, and a lot of the techs have dropped off a little bit over the last year or two. But so if you hear of someone talking about a unicorn, that's what a unicorn is.
Wow. Yeah, and I mean Canva did blow up huge.
Yeah,
huge.
And we love it.
We do. We use it all the time.
Yeah. So I guess that's an example. So if you do have people do have some really good ideas. If you wanted to pitch to a venture capital firm, what you need to do is contact them, see what you need to do to pitch to them. Obviously, it's very, very competitive. You're not just going to turn up with a PowerPoint presentation and expect to get heaps of money, but you need to do some research on what it is they want. Different firms have different things that they're interested in. Blackbird, they're typically interested in technology. There'll be others that are interested in potentially
health,
medical. Yeah, so things like that.
Yep.
So anyway, hopefully that's helped you understand a little bit more when you hear people talking about venture capital, what it is.
Yeah, interesting one, because I think it is something people don't really understand what it is.
No.
Hopefully now you do.